Inflation panic. MBMG Investment Advisory, July 2021. The data released on the 13th of this month confirmed the continued acceleration of US consumer price inflation through June, jumping 0.9% since the end of May and 5.4% from a year ago. This was largely due to increases in used car prices, along with spikes in airfares and hotel and car hire rates due to the demand driven by post-COVID reopening of the US economy. Core CPI, which excludes the volatile prices of food and energy, was 4.5% higher than a year ago. Capital markets had only recently indicated their acceptance of the explanation by US policymakers such as Federal Reserve Chair Jerome Powell that higher year-on-year CPI numbers were largely down to a combination of base effect, i.e. measuring against the sharp dip a year ago, and also supply shock, i.e. the US economy has adequate capacity to produce more goods and services, but it faces short-term challenges to suddenly deliver these, or what is being known as transitory. But how transitory? The significance of this is that supply shocks tend to resolve rather than to persist, and base effects tend to dissipate. Therefore, the uptick in inflation that's shown in the dotted line should fade away, and the long-term trend, shown in the solid line, should resume. Equity and bond market reactions were perhaps predictable. Markets are very focused on measuring year-on-year effects, and in doing so, they seem to have overlooked that the lowest data point last year was actually the 1st of June 2020 data. So although peaks and troughs rarely correspond symmetrically, it had seemed highly unlikely to us that the base effect will begin to dissipate until into the second half of this year. When people ask us when, we say Quando, Quando, Quando. It's impossible to guess when inflation will peak or just how that will look. Nobody can know. But nothing in the data causes us to rethink the transitory hypothesis. Of course, we could guess, and because supply shocks can include some sticky components, our models indicate a range that could be even as high as 3.5% to 4% year on year until the year end, and that would really panic the markets. But as we have no way to know how accurate that would be, we've simply shown below what a symmetrical progression back to trend would look like by June 2022 if year-on-year inflation were to have peaked last month. Brought to you by MBMG Investment Advisory, a member of the MBMG Group, Asia's foremost professional advisory practice since 1996.